Thank you very much. Because we have a bit less time, I did have a fair few slides. And there was some crossover with Leandros. So where I can, I will skip through them very quickly, and then try and save some time for questions. Thank you. And then there we go. Chris Elphick, UK private capital. You we were previously known as the BBCA, British Private Equity and Venture Capital Association. We changed names earlier this year. So if you saw me do this presentation last year, haven't moved jobs. It's just a new title for the same organisation. The reasoning behind that was, we were founded as the British Venture Capital Association in 1983, we've represented wider private markets, private equity, private credit for about 30 years. So I think it was just about time. BBCA served us very well, but private capital, I think, sort of is a better word for the broader work that we do. We are trade body, so our members are the venture capital and private equity funds, LPs, advisors, and we do a lot of work with government, sort of lobbying, but we also offer training events. On the VC side, I oversee the production of the BBCA model documents, which I'm sure some of you will have heard of, which are used in a lot of the sort of deals in the UK as the sort of starting point for the negotiations, and they will be updated again later this year. I'm working on those at the moment. So that's us. And the topic I was given was a nice, nice broad one, which was the state of global and UK venture capital. So I'm going to start with the global, and then I will sort of narrow it down to the UK. And because I'm a lobbyist, I've got some sort of policy suggestions and proposals at the end. So to start with the global venture capital outlook, I'm using a sort of best of data sources. This isn't UK, some of it's UK private capital, but I'm using PitchBook, Preqin, Deal Room, and this one's CB Insights for the global stuff. But they're broadly similar. When I'm talking about investment, I'm talking about VCs investing in companies, and when I'm talking about fundraising or fundraise, that's that's VCs getting money from LPs, just to make sure that we get those distinctions in early, because sometimes people use fundraising or one or the other. So that's how I will be using them. So this first one is the global equity investment. So this is not just venture. This is all sort of venture rounds. So all equity rounds where there are minority stakes. So it's not buyout. This is just and venture's usually around sort of 20-30% of it. But obviously it is venture brings in lots of other investors. So if you look at it as a sort of global market, which we've got it on here, 2021, which everyone knows was the very sort of frothy sort of peak year post-COVID, and we have seen a real decline in sort of global allocations over that time, although a bounce back last year quite considerably. And you'll see the sort of grey bar inside is the total amount raised by AI companies. So a lot of that growth is being driven by that one particular sector, as you'd expect. And actually, in a lot of these mega rounds that we're seeing, especially in the US. The other interesting thing, and I think the main point to take away from this slide, is the total number of deals. So you can see on the line there the number of deals. Even though the investment's gone up, the number of deals has gone down. Because of those mega rounds. So if you're in AI, it's looking very good. If you're in more traditional VC sectors or non-AI sectors, it's probably been quite a tough few years. I think we would be going through a more substantial sort of industry downturn if it wasn't for that sort of massive pickup from investment in AI. And just to sort of show an example of that, OpenAI, Anthropic in 2025, of that entire fundraise that I showed in the last slide, they were 16%, and that's two companies of the entirety of that money, which just shows you how much of the sort of share that these really big new frontier AI companies are sort of eating up of that. And then and because of that, because there's a lot in the US, you can see a slight rebound in Asia and Europe, and we'll come back to that in more detail. But you see the massive increase in the US there. Back in 2023. Asia, Europe combined was almost the same as America, but now, we're 3-4 times less than what's going on in the US. And again, largely driven by those really outsized AI deals. But VC fundraising, so this is money that VCs are raising from their LPs. We haven't seen a similar sort of bounce back yet. When you had, again, 2021, 22, 4,000 plus funds being raised, VC funds being raised around the world. We're now last year 86 billion, 1,200 VC funds. So VC fundraising, even though investment's gone up, back up massively, is still a real struggle. And I think what we're seeing there is, there's a flight to the big name, especially West Coast, but also some in the UK and Europe, raising huge funds. And then where funds are being raised, they're usually smaller. You're getting more solo GPs. There's a sort of bifurcation in the market between the sort of smaller new managers and the large managers, and then those who are in between who might be on the second and third fund, probably having more of a tough time of it. But we'll go more into that because I think the UK picture is slightly rosier. So I will come back to that. But again, it's interesting to see there's not that correlation with the VC fundraising, the amount being invested. A lot of that is in those peak years, there was a lot of dry powder being built up. It's hard to say how much exactly that is. Some estimates put it at sort of $200 to $300 billion globally in dry powder just in venture. In PE as well, it's another 2 trillion. So that's what's being deployed. But the actual LPs returning their money into the venture capital has not been happening, and that's because companies are taking a lot longer to get to IPO and things like that. So VC funds aren't returning. They're having longer time horizons, aren't returning money to their investors as quickly as they thought. So hence why we're not having those sort of re-ups and that money being put back into the system yet. Anyway, so conclusion on the sort of global VC piece. There's the AI fast lane, as I said. If you're investing in AI and you're taking off, you are having really competitive deals. The founders are getting much more competitive terms. They're raising lots of money and really taking off. And the rest of venture is harder. And those deals are in lots of sort of down rounds, and things like that. So I think AI is sort of warping the figures in that regard. US taking off, and as I said, VC's taking longer to fundraise, and that sort of squeezed middle of funds in between the mega funds and the emerging funds. So venture capital in the UK. I'll cover some similar ground to Leandro's here, so I can skip through some of this. But if we just look at the investment in companies, you didn't see that dramatic drop that we saw in the global stage. UK investment has held up pretty well. So this is equivalent sort of equity rounds, so not just venture. This is everything else as well. But in those sort of early, late stage deals. So the actual investment did pick up again quite considerably last year, again, driven by the UK equivalent of those big AI deals. But the number of deals, again, you can see on the line there, has continued to go down. So you're seeing fewer, larger deals driving a lot of that growth, but the overall investment market, more generally, is probably more harder for founders to raise because there are fewer deals being done. So that's UK. This is the last set of data was Bohurst. This is Deal Room, just so you know. But they're not too far off in the overall investment, and this is just quite a good. Just shows you. The UK share of the, still by far ahead of our European competitors in terms of investment. Will come with funds. It's actually a bit of a different story. But in terms of investment, and people in the government always love doing this, that the UK is bigger than France, Germany, and plus one other country. They've even thrown in 2 more here: Germany, France, Switzerland, and the Netherlands. So, in terms of investment, the UK is more than the next 4 largest combined. So, still by far ahead in terms of deployment. But, the UK and London in particular being the biggest hub in Europe, which is great, and hope that continues. And again, AI, you can see, so a reason for that big uptick we saw in the investment. Again, AI has really taken off. That's you see the 2025 data there, 8 billion. So it's what's that? A third roughly of the overall investment is into AI companies. So again, that's what's driving a lot of the growth. And in AI rounds, 2/3 of them are in London, as you would expect. So fundraising, slightly different story. This is our data. So we get the actual underlying data from our members on where they raise their money, how much money they raise, in terms of the funds closed, because that's not always publicly disclosed. And these are just GP LP funds. So now you get, listed funds, EIS funds, VCTs. That's not included here. These are just the classic 2 and 20 GP LP funds. You see, it's not, it's up and down. And last year, only it was a 50% drop. I think that's more of a coincidence to the fact that none of the big funds raised. So the index bulletin type funds didn't raise last year. So, but in terms of the number of funds, it wasn't down massively. So you had more smaller funds, those emerging funds being raised last year. As Leandros was saying, I think the BBB have now got a much bigger mandate this year, and they're back, they're making an announcement every week or so about a new fund that they're going to back. So I think this year the picture will, it will pick back up again. But it is interesting to note that in terms of VC fundraising, Here's a bit of a confusing graph, but if you just look at the last slice there, the UK is #1 every year in terms of European deal share, in terms of what they raise from VC, as a VC funds raised. But in 2025, our crown was taken by France, and France raised more money than the UK. Now, again, there were some large French funds that raised last year that didn't raise in the UK, so I think, but for me personally, I think it's good that Europe's raising more money. It is getting a lot of its institutions to back its VC funds and is really scaling. So that's good. We need the competition, and maybe we'll see in those investment charts, we'll see that flow through later on. But it's interesting that UK is still far ahead in terms of investment. When it comes to VC, the rest of Europe is catching up, and I think that's no bad thing. So what does this tell us? I think investment, as I said, resilient. The mega rounds fueling the growth, and Europe catching up. And again, there is a squeezed middle in the UK as well. So now I'm going to sort of come to, as I said, because I'm a lobbyist, so I'm going to talk about what sort of government support there has been. There's actually been, despite the headline narrative about what's going on with the government, some quite good developments here. I mean, maybe not in the wider business environment, but just purely for startups and venture, I think there's actually been the government have done some very good things. So in that one regard, we should thank them. And in terms of people think that the government doesn't have a mantra. They do have this one for our part of the world, which is basically they want the UK to be the best place to start up, scale, and stay. A couple of years ago, it was always about we want the UK to be the best place to start and scale, but now they've added the stay bit, because that is, they don't want us losing, these companies. We put so much money in at the early stage, so much great research coming out of the universities, everything else, but then losing the upside when other investors come in. So they want the companies to stay here and have not what happened with DeepMind and Arm and other things, where other companies where we lost. We didn't lose, but because those companies are still here. But in terms of the ultimate exit, the UK didn't see the full value of that. So that's what they're trying to address. In the budget last year, I think there was talk about it being the entrepreneurship budget, which, and I think, there was some very good stuff in there. EMI, so the Enterprise Management Incentive Scheme, which is a really good scheme. They made it even more competitive, lifted a lot of the limits. So that gives, startups, more of a stake, gives them tax breaks in order to, go and work at a startup and stay in that company for longer, which is great. The tax advantage schemes have had a lot of their investment limits lifted, so those companies can now raise more from these types of investors, which we've been calling for a long time. If there are any VCT investors in the room, I know they did cut the income tax benefit for VCT schemes, and we're pushing back against that. But overall, if you're a company, this is all good stuff. Listings reform, there's been a lot of talk around that. I know Neil from the LSE is here speaking later on. We want to be a more competitive destination for listings, and there's this stamp duty holiday, which I think is a good start. I think there's a lot more to do on that, but still, I think it's a move in the right direction. And then pensions is a lot of the stuff that Leandros talked about, VentureLink, etc., which again is sounds very positive. And then in terms of the new sort of institutions that the government have set up, and I'm actually pretty positive about. Well, obviously, British Business Bank has been there for a long time and is doing a great job. We don't need to go back over that. Sovereign AI, the Sov AI fund, which has been given a sort of free mandate, and its chair and its two investment partners are from Balderton, Y Combinator, and the managing partner is from Local Globe. So they're giving the experts, the sort of discretion to back, and invest in some of these AI companies. I know they invested in Ineffable Intelligence recently, and they've done several other deals. They also give you access to compute power, the companies they back. So, it's a real good joining up of the sort of VC and government expertise and benefits. So, I'm very positive about that. I think it's a great thing that the government have done, because quite often when you set up these government kind of funds and things like that, they put, sort of too close guardrails around them, and they can't sort of freely operate and have the right expertise, but I think they have in that case. So Leandros spoke about the scale-up gap, and I spoke about that last year, and I think that is very well understood. UK companies do not tend to raise as much as their US counterparts, and that is still an issue and something we need to solve. But what I'm going to talk about is more the domestic capital gap. And this is more about, as I was saying earlier, what the government are trying to solve around the upside of this amazing companies, this amazing talent we have that we do lose and continue to lose. And I worry we'll still continue unless we make some changes. There we go. So yeah, the opportunity for UK tech and venture has never been greater. Create amazing talent. But yeah, the business is captured overseas, and we're reliant on overseas capital. And that's not just at the company level, but also at the investor level. Which I'll come to. So we sort of lose it in both sides of what we do. So, The opportunity is clearly there. If there are any VCs in the room, I could fill another page with great VCs. I just got that off Google. There are many, many great VC funds in the UK. Do they need more capital? Maybe they do. But there's already ones that are already there who raise a lot of capital and are fantastic. And so many of them say to me, I would love it if my LPs were in the UK. I always ask them, do you get any pension money, any UK LP money? And they'll say, well, British Business Bank might be one, but apart from that, it's usually no. It's all from the US. A lot of it's from Japan. So they need to go off and see their LPs all over the world, and they can't raise any money in London, which just seems slightly mad. They were like, I'd much rather go and meet my LPs across, London rather than going flying around the world to see them. And quite often, 90% of their capital is raised overseas, which just seems slightly crazy. So even if these, VCs, and some of them do invest in these a lot of them do invest in these companies, the money that those VCs are deploying is also overseas capital as well. And then at the later stages, and this is just an illustration of what happens at the later stages and how reliant we are on overseas capital. As the rounds increase, you can see the overseas capital taking over to when you get to large-scale 50 million rounds, where 85% of the capital comes from overseas. At pre-seed rounds, it's 96% UK. And it literally, as you further go up the value chain, the more overseas capital takes over. And we see that in some of our biggest companies. So Synthesia, 11 Labs, two of our sort of AI flagship companies, early stage, seed, pre-seed, MMC and seed camp backed Synthesia. As soon as you get to Series B plus and you go up to the scale-up rounds where, a lot of the value is taken up in those companies, you've got Firstmark, Google Ventures, 11 Labs had Andreessen's and Sequoia. So they're the ones sort of putting in the scale-up capital and then taking up a lot of the value. And when those companies sail, and quite often they list in the US or whatever it might be, the returns that those companies generate are going elsewhere. They're not coming to the UK. And even when the venture funds themselves are invested in them, their capital is also largely from overseas. So we don't quite have 2025 data yet. We'll have that very soon. But the 2024 data, which is just illustrative, we have a really strong mix of LPs in that pie chart. You've got pensions have put in 400 million there. That's all overseas pensions, none of it UK. The 6% I think down there is British Business Bank, government agencies. So really, again, a really substantial investor in UK VC, and that's really positive. But again, 75% of it came from overseas. So, even the UK venture funds, as I said, it's really demonstrated there. And without the British Business Bank, people are like, oh, should we have the stake back in these companies? Without the British Business Bank, there would be probably very, very little tiny, very small amounts of UK institutional capital backing venture funds, which is why they are so important. So obviously Mansion House has driven a lot of that, discussion and hope for change in this regard, and Leandros touched on it. But we did a survey in the last month about how much investment there is in UK venture GPLP type funds. Obviously, there are the British Business Bank vehicles that are great. Some pension schemes are investing directly in scale-ups and have done so, which is great. But if we're talking about venture and growth funds, there is, out of 84 firms we surveyed, and that included all the big names which I showed previously, only 2 have got money from a UK DC pension investor. One of those was an investment trust. So if we talk about GPLP, it's 1 in the entirety of the UK ecosystem, or, in terms of the 84 firms that we surveyed. Several of them did have local government pension schemes and things like that, but it's still a very small amount. But if we're talking about the Mansion House reforms, which I won't go into the background of that, but I'm sure at least some of you will be aware of it, it's still effectively, it was 0 and now it's slightly less than 0, but it's still not very much. So, solutions. So we as UK Private Capital have some. The first one, which I like is a new tax break, scale-up reinvestment relief, which is for founders. I think the tax system in the UK has a lot of really great tax breaks. There was the tax advantage schemes that I mentioned earlier. We did have entrepreneurs relief. That's been scaled back, so it's not really effective, or it's not really meaningful. It only goes up to £1 million now. So I think that's where the gap is. And what Treasury has always found frustrating about the release they give is it doesn't get reinvestment. It doesn't get that flywheel. It doesn't get the money coming back in. So we created a do as it says on the tin type relief, which is basically if on a point of exit, a founder in the UK reinvests, you can either make it a percentage of their money or a certain amount, they then get a deferred CGT treatment, so they get, they get the tax break as long as they reinvest a certain amount of it, and then, stay in the UK, reinvest, also give back their expertise. That's really important as well. So on the boards of these companies, we get more of that behavior coming through. So that's one. And we're hoping to push for it in the budget later in this year, depending on who the chancellor might be or whatever. But that's one which we think is a bit of a gap and is something that can really work. They did it in Sweden, and I'm sure there's been quite a good, some good startups like Lovable and others coming through in Sweden, and has helped create that kind of ecosystem. So I think there is a gap there on pensions. We have a sort of UK version. There was a Tibi scheme in France, which was Macron going around to all the big institutions in France and saying, back our tech and our VC funds, and it's deployed, I think, more than 10 billion euros, might be 15, into their ecosystem, and has worked very well. We have Mansion House, which has got the commitments, but we're not seeing the money come through, as I said. So if we have a similar scheme here, we need to be pushing on this agenda to make sure it happens a lot faster. It's been 3 years now since the original announcements. So there's that, and then Leandros mentioned a British Growth Partnership, which is investing directly in companies. Hopefully the next stage of that can be a fund of funds, or there can be some way we can set up as a fund of funds to get the money into the venture funds and the experts who are actually doing the deals and everything else. So that's something which we would like to see come through. I know we had the deputy mayor due to speak, but I don't think he is. Another thing which a lot of people say we need, and we have various versions of it around London, but there's Station F in Paris, which has all of the big scale-ups in France. It has all the corporates and the corporate venture funds in one space. Should we have a similar point of contact in London? I think it has to be in London, I think, to bring in those big institutions and see UK scale-ups and invest in them. So that's another thing which people push for, and something we should think about. But yeah, I think so. That was pretty much everything I had on the slides. So again, to conclude, UK has a world-class tech ecosystem. We now need to capture the value of it. I mean, whether we think it needs to grow further, it certainly does. But in terms of what we already have, we're missing the opportunity. We need stronger convictions from our public institutions, from us ourselves, to really sell what we have. British sense of irony and self-deprecation doesn't always really work. We really need to sell this stuff and really be proud of what we've created. And AI is a once in a generation opportunity. We've missed out on the last few tech cycles in terms of the upside, and we can't let that happen again. So that's it. I went through that as quick as I can. Sorry if I still went a bit over time, but yeah, I am happy to take questions if we have time, one or two.